Investing is all about putting your money to work instead of you going to work. If you can make your money grow over time without you actively doing anything, then congratulations. You have become an investor. In today's economic situations, becoming an investor is not optional. It is mandatory for anybody that wants a secured future. And that is because one day you will be forced to stop working. But inflation and unexpected heavy expenses will be coming after you. So making your saved money grow is a necessity. The stock market is not the only investing option for retail investors. Stocks keep going up and down randomly. And for those of you who cannot handle the volatility of stocks, there are some assets which give you guaranteed returns. So today we will be discussing 5 investment options with their pros and cons. Our option number 4 is not even considered an investment by many finance experts. But I am going to show you how it is going to be one of the best investments that you will ever make. And option number 5 can create massive wealth for you. But you need to understand all of them to become an intelligent investor. So let's begin. Namaste and welcome to Retail Investing. So let's start with the option which is the most boring and also the most essential investing option, and that is some of the services provided by your bank. Number 1 is your regular savings account, and there is not much to explain about it. But we can try to understand what is the best way to use your savings account by looking at its pros and cons. So you keep your saved money in a savings account and the bank pays you a very small interest, around 3%. The biggest advantage of keeping money in a savings account is liquidity. You can withdraw and deposit your money immediately, and you can do it as many times as you want without paying extra fees. Plus, you get some additional services like a debit and ATM card and a checkbook. And your deposits up to 5 lakh rupees are insured by the Reserve Bank. Now, the main disadvantage of keeping money in a savings account is that the interest rate is too low. It's even lower than the rate of inflation. Plus, the interest income is totally taxable. So what many people like to do with their savings account is avail a service called Auto Sweep. With Auto Sweep activated, you will get the fixed deposit interest rates, which is almost double the savings account interest rates. But I personally like to avoid Auto Sweep because the minimum balance to be maintained is too high. In case of SBI, you will have to maintain a minimum balance of around 30,000 for Auto Sweep. While for a regular savings account, there is no minimum balance. You see, minimum balance is just a fancy way of saying you will have to donate that money to the bank because you can never take that out. I'm not going to do that. So your savings account gives you guaranteed returns with no losses in the short term, but there is also the guarantee that you are going to lose money to inflation in the long term. So it is a good place to invest only that money which you are going to spend within the next 3 months. And secondly, you can store money in your savings account until you have a large enough amount to invest in some real assets. Number 2 from this category is a fixed deposit account, and you all know about it. So your fixed deposit gives you guaranteed returns, and the interest rate is much higher than the savings account interest rates. And the Reserve Bank insures your investments of up to 5 lakh rupees. No wonder FDs have been India's favorite investing option for decades. So in this graph, the orange line shows the FD rates since 1970. As you can see, in the 90s, FDs gave returns as high as 12%. So the risk-adjusted returns for FDs was better than what the stock market had to offer because FDs had no volatility. It makes complete sense why Indians loved FDs so much. But times have changed. Today, the FD rates are very low compared to the rate of inflation. And considering that FD incomes are fully taxable, you are losing a lot of money in the long term. However, fixed deposits for shorter periods are still decent investments. I think it is time for retail investors to start understanding bonds, even if you don't have any plans to invest in them. And that's because bonds tell us a lot about the macroeconomic situation, and it definitely affects all other kinds of investments, including your stock investment. So let's understand the basics. So if you buy a bond, you are actually not buying anything. You are just giving a loan to someone who needs it. And this needy person is called the issuer of the bond. Usually governments need the most amount of money, so government bonds are very common. Public sector companies and private companies also raise money via bonds. When you invest in a bond, you get annual interest payments, and after the maturity period is over, you get your principal back. But just like stocks are traded daily in the stock market, bonds are also traded and sold before maturity in the bond market. So bonds can be a fixed income asset for you if you choose to hold them till maturity, or it can be a volatile asset like stocks if you choose to buy and sell them in the bond market. Now there is one important fact that everyone should definitely know, is that if you have a pension account like an NPS account, the majority of your hard-earned money is invested in bonds. The level of risk in bond investing depends on the rating given to the issuer of the bond. Now there are rating agencies like CRISIL and CARE who give these ratings. So bonds issued by the union government will be the safest because they will have the highest ratings and they will also have the lowest risk of defaults. But with low risk, you will also get low returns. The riskier bonds pay more interest. In fact, there is a category of high risk bonds which are called junk bonds. As per the rating agencies, these bonds are not worth investing in. The risk of default is so high that they are put in the junk category. But skilled investors make money even from junk bonds. Famous investor and one of the most brilliant minds of the finance world, Howard Marks, has made fortunes from junk bond investing. If you invest in the bond issued by a company instead of its stock, you will get no share in the company's profits. If the profits of the company go up 10 times in the next 10 years, the stock price is also likely to go up 10 times. So stock investors' money will grow by 10 times, while for bond investors, the reward will be 7, 8 or 9% annual interest payments. That's all. Now, con number 2 of bond investing is that long-term bonds are vulnerable to inflation. To know why that happens, you will have to understand the concepts of bond yields and bond prices and how they are affected by changing interest rates. In this video, we will not get into the details of those things, but we will try to understand the future of Indian bonds because something big is happening. So whatever money the government raises by issuing bonds is called sovereign debt. Foreign investors are allowed to own up to 6% of India's sovereign debt. But as per the latest data, foreigners own only 0.5% of India's sovereign debt. Recently, something big has happened with Indian bonds. JP Morgan's government bond index of emerging markets will include Indian bonds from the June of this year. And followed by this news, Bloomberg has also decided to include Indian bonds into their emerging market bond index from the September of this year. And Goldman Sachs thinks up to $40 billion can enter the Indian markets via bonds in the next 18 months. Nothing of this magnitude has happened before. It is becoming clearer and clearer that India is emerging as the favorite investing destination of the world. And China is definitely fading away. Now all these fixed income assets that we have discussed so far can be good investments for the short term, but in the long term, all of them make you lose money to inflation. Now, it is a very special category of investing and nobody talks about it. Have you seen those passionate people collecting commonplace things like postage stamps, coins, postcards, and paintings? This collecting is not just a hobby, it's an awesome investment. When things get old, they become more desirable, and the main reason for that is that these things go out of production in the future. The supply becomes zero, but the demand does not become zero, so the price could be anything. You can collect any item you love, but make sure it is durable enough and it can be expected to go out of production in the future. It could be a nice watch, it could be a DSLR camera which has mirrors inside it because everything is already mirrorless. It could be comic books, toys, dolls, sneakers. And for people who enjoy drinking, consider buying a bottle of whiskey and not opening it for decades. It can make you rich someday. Now the cons of becoming a collector is that your collections might get damaged, lost or stolen. And secondly, the holding period has to be very, very long. It can last up to generations, but they can make anybody rich with very little money invested. And guys, I was talking about collecting real items, not those digital fantasy coins and photographs which kids are minting on their graphics cards. We are not going to talk about commercial real estate or REIT investing. We will be talking about buying a house, and this is the category which is not even considered an investment by many finance experts. Now, before we get into the numbers, let's understand this fact that nobody makes losses after buying a house. You want to know why? Because they hold their assets for really long periods. A 15 to 20 year holding period is very ordinary for house owners. Imagine you are living in your own house and the house prices suddenly crash. You won't get scared and try to sell it, like what most people do with stocks and lose money. So let's have a look at the math to understand whether buying a house can be called an investment or not. So let's say you buy a house worth 50 lakhs. You will be paying only 10 lakhs from your pocket as down payment. The remaining 40 lakhs will be paid by a bank. Now, house prices do not appreciate much every year. It goes up by only 3 to 5%. But you as a owner will be getting much higher returns than that. If the price of your 50 lakh rupee house increases by 5% to 52.5 lakh rupees in year 1, your return on investment is not 5%, it is 25% because you invested only 10 lakhs and not 50 lakhs. Now we definitely cannot ignore the compound interest that you will be paying on the 40 lakhs you borrowed from the bank. But still, it is the best and it is the only compound interest that anybody should be willing to pay. You see, banks sell home loans at much lower interest rates than other loans. Plus, the government happily gives you tax breaks on your annual installment payments. This does not happen with any other kind of loan. In case of a home loan, both the borrower and the lender can be winners. Now, there is also a qualitative aspect on the personal level for house owners and aspiring house owners. You see, in any field, the difference between the winners and the losers is habits. Even in investing, habits decide who is going to win and who is going to lose. Someone who cannot make the habit of saving money to buy a house, can they ever make the habit of saving money to buy a mutual fund? Not likely. Your salaries will keep increasing, but so will your rent. In case of buying a house, the EMIs will stay more or less the same over long periods of time, except for the few years of high inflation, like what is happening now. Plus, after paying all those rent for decades, you won't be left with any asset. But for the ultra-rich people, renting might be a better decision than buying. The founder of Zerodha, for example, does not own a house. It makes sense because luxury apartments have reached ridiculous prices of up to 100 crore rupees in places like Mumbai. An entrepreneur can easily invest that kind of money for high returns while living in a rented luxury house. Plus, the tenants who live in luxury houses don't have to deal with annoying landlords. Everything is professionally managed. But for the common man, the retail investor, buying a house will be the better option in most cases. But buying multiple houses as investment is not a great idea. The opportunity cost would be very high. There is only one investment option which has the potential of becoming a better investment for you than owning a house, and it is stock investing. So here are the returns generated by various asset classes since 1945. It's quite clear that stocks have massively outperformed every other asset class over the last century, but people like to call them a high risk and high reward asset class. If something generates high returns over decades, why call it high risk? You see, high risk comes from not having clear goals. Not just in investing, but in every aspect of life. On social media, the finfluencers like to intimidate you with their screenshots of massive numbers. But in reality, you don't have to be a crorepati or even a lakpati to start playing the game of stocks. And the game of stocks is not a dangerous game at all. It's not like that if you play it, you either win or you die. There is nothing to lose and you can start with literally zero money. You can start with entering some data in an Excel sheet. Names of some stocks, the price, and the date on which you are adding them. Well, the thought process is very simple. Behind every stock, there is a business. Try to think about those businesses whose products and services you use and like. And then you can use your imagination to assess the future demand for those products and services. I found my biggest multi-bagger stock just like that. Once I traveled in a nice electric bus and I liked the bus so much that I had to talk to the conductor. I inquired about things like the range, the charging time, and the costs of running the bus. And the next day I added the name of the stock to my Excel sheet. The stock price has gone up 4 times from that date. The name of the company is Olectra Greentech and its growth story has just begun. So playing this game of stocks on an Excel sheet is very similar to what fighter pilots do as a trainee. They fly in a simulator in the beginning so that they don't end up crashing a real aircraft. You can try the same. There is nothing to lose and a lot to gain. You won't be losing money by selling in panic situations, and you might be surprised by the returns generated by some of your stock picks over the years. It would be really nice if Zerodha adds a virtual portfolio section in their app instead of just watch lists. You see, all the millionaires become millionaires in their thinking way before they see $1 million in their bank account. Now, this is not a motivational speech or something, and I'm not trying to sell you a Chaiwala franchise. This is just a blueprint to start thinking like a millionaire, and it begins with some simple calculations which can be done totally free of cost. Warren Buffett once made those calculations, and he got convinced that he would become a millionaire by the age of 30, and the rest is history. In the last couple of weeks, the stock market has been going up and down a lot. So you should definitely watch this video to understand what to do in this situation. Jai Hind.